Hi, everyone.
Welcome to our channel, where we simplify complex insurance topics to help you ace your insurance license exam. Today, we're diving into 28 key insurance terms that are essential for your exam. Whether you're just starting or need a refresher, this video will make these concepts clear and easy to understand. Let's get started. 1. Adverse selection. Adverse selection occurs when higher-risk individuals are more likely to seek insurance. This can be a problem for insurers because they might end up paying more in claims than they collect in premiums. Example: a person with a history of car accidents is more likely to buy car insurance than a safe driver. Solution: insurers use underwriting to assess risk and charge higher premiums for higher-risk individuals. 2. Hazard. A hazard is any factor that increases the chance of a peril, cause of loss, occurring. Types of hazards. Physical hazards, tangible conditions like icy roads or poor health. Moral hazards, dishonest behavior like lying on an insurance application. Morale hazards, carelessness like leaving your car unlocked because it's insured. 3. Homogeneous exposure units. Homogeneous exposure units are similar objects of insurance exposed to the same group of perils. Example: insuring 1,000 identical homes in the same area makes it easier to predict losses. 4. Indemnify. Indemnify means restoring the insured to the financial condition they were in before the loss occurred. Example: if your car is totaled, insurance will pay to replace it, but not more than its value. 5. Indemnity. Indemnity is the amount needed to restore someone to their pre-loss financial condition. Example: a $10,000 payout to repair a damaged roof. 6. Indemnity contract. An indemnity contract is designed to return the insured to their original financial position after a loss. Example: property insurance policies are indemnity contracts. 7. Law of large numbers. The law of large numbers states that the larger the group of similar risks, the easier it is to predict losses. Example: insuring 100,000 homes makes it easier to predict fire losses than insuring 100 homes. 8. Loss. A loss is an unintentional decrease in the value of an asset due to a peril. Example: a car accident that destroys your vehicle. 9. Loss exposure. Loss exposure is the risk of a possible loss. Example: a business located in a hurricane-prone area has high loss exposure. 10. Loss exposure unit. A loss exposure unit refers to each individual, organization, or asset exposed to potential financial loss. Example: each home in a neighborhood is a loss exposure unit for a property insurer. 11. Moral hazard. A moral hazard arises from the insured's dishonest behavior, such as lying or committing fraud. Example: a person faking an injury to claim disability benefits. 12. Morale hazard. A morale hazard arises from the insured's carelessness due to having insurance. Example: leaving your car unlocked because it's insured. 13. Peril. A peril is the immediate cause of a loss, such as fire, theft, or a car accident. Example: a fire that destroys a home. 14. Physical hazard. A physical hazard is a tangible condition that increases the chance of a loss. Example: icy roads increase the risk of car accidents. 15. Primary insurance company. A primary insurance company is the first to pay a claim or the insurer that transfers part of the risk to a reinsurer. Example: ABC Insurance pays the claim first, then shares the risk with a reinsurer. 16. Pure risk. Pure risk involves only the chance of loss, with no opportunity for gain. Example: illness, injury, or property damage. 17. Reinsurance. Reinsurance is when one insurer transfers part of the risk to another insurer. Example: ABC Insurance shares a large risk with XYZ Reinsurance. 18. Reinsurer. A reinsurer is an insurance company that assumes part of the risk from a primary insurer. Example: XYZ Reinsurance takes on part of ABC Insurance's risk. 19. Risk. Risk is the uncertainty of loss. Example: the chance of a car accident or a house fire. 20. Risk avoidance. Risk avoidance is eliminating an activity to prevent a potential loss. Example, not skydiving to avoid the risk of injury. 21. Risk management. Risk management is the process of identifying and handling risks. Example, buying insurance to transfer risk. 22. Risk reduction. Risk reduction involves taking steps to minimize the chance or severity of a loss. Example, installing smoke alarms to reduce fire risk. 23. Risk retention. Risk retention is accepting some risk yourself, often through a high deductible. Example, choosing a $1,000 deductible on your car insurance. 24. Risk selection. Risk selection is the insurer's process of deciding whether to cover a new risk. Example, an insurer reviewing a driver's history before issuing a policy. 25. Risk sharing, risk pooling or loss sharing. Risk sharing spreads risk among multiple parties. Example, co-insurance and health insurance policies. 26. Risk transfer. Risk transfer involves transferring risk to another party, like an insurer. Example, buying car insurance to transfer the risk of accidents. 27. Self-insurance. Self-insurance is maintaining reserves to cover potential losses. Example, a large company setting aside money for employee health claims. 28. Speculative risk. Speculative risk involves the chance of both loss and gain. Example, investing in the stock market or gambling. And that's it. You now understand 28 key insurance terms that are essential for your license exam. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell for more exam tips. Good luck, and I'll see you in the next vid.